Hi everybody, it's Maureen, your local lender with Rate, here with this week's Mortgage Minute. Today is Wednesday, April 1st, and it's about 8 a.m. So yesterday's JOLTS report showed job openings declining and weaker hiring activity, which is just reinforcing the signs of a softening labor market. At the same time, consumer sentiment is falling, indicating that households are starting to feel the financial pressure, especially with oil prices now over $100 a barrel. Now, what's interesting, though, is the shift that we've seen just in the past week. So initially last week, interest rates moved higher due to the rising oil prices, the geopolitical tensions, and the renewed inflation concerns. But as we've moved into this week, that momentum has reversed, and mortgage rates are now starting to come back down and improve. The bond market is now shifting its focus away from inflation, including the impact of oil, and instead zeroing in on the broader economic slowdown. And this is why rates are starting to come back down, at least for now. And according to this, or adding to this, Fed Chair Jerome Powell recently struck a more dovish tone, which has increased expectations for future rate cuts, which then fueled the bond market rally and further supported the lowering of mortgage rates that we have seen this week. But what about the housing data? Well, the Case-Shiller Home Price Index showed home prices are still inching up, but at a much lower pace. Home prices are up just under 1% year over year. And while values have risen over the past 6 months, affordability continues to be a major challenge. And with rent still significantly cheaper than owning in many of the markets, this is keeping some home buyers on the sidelines, which is then impacting overall home sales activity. As we head into the rest of the week, the big question is what is mattering more, or what matters more? Inflation from rising oil prices or signs of a slowing economy? Markets are going to be watching the jobs and the consumer spending reports very closely, because if the data shows the economy is slowing, well, that could help keep rates moving lower. But if inflation starts heating up again, rates could rise. Oil, that's the wild card here. If it stays high, that could push rates up, but if it eases, that's good news for rates. So bottom line, expect the continued ups and downs and roller coaster ride we've seen the past couple weeks, but be ready because there may be a short-term opportunity. Timing matters more than ever, and make sure you have a strategy in place and don't get greedy with rates. All right, guys, that's it for now. We'll see you next week.